Okay. Good afternoon. We are Atlas Partners. I'm Patrick. We have Sheldon, Tara, Bethany, and Spencer to my right here.
So to give an overview of what we're going to be talking about today, we're going to go into a little bit on the macro environment and then our sector outlooks, both near term and long term across our 6 different sectors that we're focusing on. Then we'll go into our fund considerations. And then lastly, we'll go into our investment opportunities, looking at the equity opportunity and the credit opportunity, and telling you a little bit more about whether we should invest in those or not.
To start off, we'll go ahead and look at our current portfolio and then talk about that macro environment that Tara mentioned and give a look at our sector outlook. As we can see here, as of Q3 2023, our portfolio stands just under $5 billion in gross asset value. And as we look, we're currently levered to just under 47% LTV across the entire portfolio. We also have outstanding withdrawal recommendation requests of 4.5% NAV that Bethany will get into when we look at our analysis. As a reminder, our fund objectives are to provide those core plus returns as well as beat our benchmark, which is the open-end real estate core index. We have a flexible investment mandate on what we can invest in across the sectors, and we also have the ability to invest up to 10% of our net asset value into debt instruments. As we look at our current fund composition, we can see that the majority of our capital is employed in residential, industrial, retail, and office space. And we also have a position currently in data centers, storage, and a parcel of land.
So briefly going over the current macro environment, we have seen that the year-over-year CPI has decreased to 3.7%, with that figure excluding housing being 2%. If we go on the rate side, our projected 10-year UST rate is supposed to be in the 4 to 5% range, which is quote-unquote the new normal. And to get our long-term average cap rate, we believe that's 150 to 250 basis points over that 10-year, bringing the range from 5.5% to 7.5%. On the employment side, we've seen the unemployment rate tick up a little bit while wage growth has decreased, and we do believe that there is a possibility for additional recessionary indicators in 2024. Now, in the next few slides, we're going to go over our sector outlook, specifically our near-term and long-term convictions for those different sectors. So starting with residential, both apartment and single-family rental SFR, we believe in the near-term and long-term that those will be positive. In the near term, we have seen rent growth in 3Q23, and then also a good supply-demand projected, especially in the Sun Belt states. For SFR, we've seen various different factors listed above that will support demand within that space. And then in the long term, from the apartment side, we do believe that there is favorable supply in 2025, given we do see increased construction financing as well as completion of those 2023 starts. And then on the SFR side, we do believe that demand will be supported by the millennials aging to that prime cohort. On the industrial side, we do believe in the near term it is negative, given that we have seen those vacancy rates increase, net absorption abating from record highs, and then a pause in leasing activity amid the economic uncertainty. But we do believe that this will only be in the near term, and then the long term it would be a good investment, given we have seen strong investor appetite and the physical vacancy rates still remain below that post-Great Financial Crisis average. In the office space, we do believe that this is negative both in the near term and long term. We continue to see negative absorption within that space, trending and leasing going downward, and then record low occupancy, and then that we continue to believe will translate into the long term as well. And then in the long term, I think we have seen the impacts of the COVID pandemic, that transition from in-office to the hybrid/remote environment, which we do believe that will continue to put pressure on the space, especially at the risk of a weakening economic cycle.
When we turn our attention to the retail sector, in the short term, near term, we have a negative outlook, and this is primarily driven by the fact that year-over-year retail sales fell for the first time since the onset of the pandemic at the end of Q2 2023, as consumers are less willing to go out and spend their money with some uncertainty on the horizon with the general economy. However, in the long term, we do believe that there may be some opportunity there with the neighborhood and community center retail space in high traffic areas performing best among this sector. When we look next at our data centers, we see both near-term and long-term positive outlook here. The reason for this is we all know in the last several years, the revolution and the popularity and demand for AI, machine learning, and cloud computing and storage has really driven a lot of demand in data centers specifically. Because of this, rental rates have been able to increase as supply has not kept up with that demand. And we believe into the long term, this will be a trend that is ongoing, with a lot of those cloud providers being the primary occupants of those data centers. Finishing up with our storage sector, we see in the near term a potential opportunity to dispose of some of these assets, as our research team believes that cash flows in storage assets are positively correlated to economic cycles. So with some uncertainty on the horizon, we believe it may be a good opportunity to get rid of some of that. However, in the long term, we believe that there is the potential for storage assets to become once again attractive. And we'd want to sit on the sidelines until that opportunity arises and we can take advantage of that. We do want to take a moment to talk about our low growth and recessionary strategy. Should that kind of recessionary period hit, our team has come up with the following action plan. First, we would strive to improve our current cash flows by increasing occupancy rates in our properties, as well as looking for ways to increase our current rental rates for lessees that we have. Afterwards, we would take a look at the entire portfolio and assess what assets might be underperforming and where there might be opportunities quarter over quarter to dispose of those assets and put the capital to better use in other areas. Lastly, after all of that, if we have additional capital to employ, we would take advantage of the opportunity to go up to that 10% NAV into REITs and commercial mortgage-backed securities. This would allow us to diversify away some of the risk of being invested in just a single project, as well as still allow us to get modest returns on our capital.
Thank you so much, Spencer. I'm now going to take a couple minutes to look at some of the fund considerations. We're going to start with liabilities and redemptions. First and foremost, we want to discuss 3 secured apartment buildings and the loan that's maturing at the end of Q1 in 2024. We are going to refinance that, but because of the changing nature of our access to debt, we will not be able to refinance the full $121 million. So we're going to pay down $38 million and refinance the remaining 83 at 6.5% interest. We do have a line of credit. Currently, we have $100 million drawn in it with access to another $150 million. Because that access is at 7.5%, we're choosing to not access any of it within the upcoming year, and we're just going to maintain that balance since it doesn't mature until 2026. And finally, we want to talk about the redemptions, looking at 3 different redemption periods, starting with the one that just ended in Q3 of 23. We had 4.5% requests. Of that, we're going to pay 2.5%. We do think that over the upcoming 2024 calendar year in Q1 and again in Q3, that we're going to see a reduction in overall redemption requests. As you can see here, we're projecting down to 3.5%, of which we'll pay 2.5%, and then in Q3 of 24, down to 1.5%. Here broken out a little bit more, you can see the actual dollars and cents of it. Starting first with the redemptions, again, you can see those reducing. That's in part due to the reduced amount of requests that we're projecting. And additionally, it has to do with the reduction in net asset value that we intend to see as gross asset values tend to decline throughout the year. Additionally, you can see the $38 million that we are going to have to pay down as we refinance the debt, and a credit opportunity that my colleagues will discuss a little bit more in just a minute. And we're going to pay for that leaning heavily on cash that we already have, as well as disposing of 2 properties, an apartment complex, as well as a small portfolio of storage assets. Breaking down a little bit more by quarter here as we go through to the end of 2024, I just wanted to point out that our overall loan-to-value rate should not exceed 55% for the portfolio. We're starting at 47%, and we do get dangerously close there. getting up to 53% by the end of the year. Mostly that is driven by the overall reduction in gross asset value throughout the course of the year, which we're projecting portfolio-wide to be about 13%. Additionally, one area we wanted to draw attention to is the liquidity, starting off at 8.9% at the beginning of the year, ending at 5.2% because of how heavily we're relying on cash as we go through the year. Drawing a little bit more attention to some of the numbers and a couple possible areas for concern. The highlighted areas show two portions of our portfolio where the loan-to-value rate is a little bit high. First, looking at data centers, it starts off right at that 55% mark and goes a little bit higher, but we aren't too concerned about this. As Spencer mentioned, we do believe very strongly in data centers moving into the future. Additionally, and a little bit more alarmingly, we see up to a 71% loan-to-value rate in our office holdings, driven mostly by a projected 20% reduction in gross asset value. We'll discuss here, next one, that as office as a whole class is not doing favorably, but we did have an option to dispose of an office asset, but chose not to. The primary driver of that was at the asset level. This particular property is doing quite well with a very strong tenant and a low interest rate on the loan. Looking at the properties that we did decide to dispose of, the storage, as Spencer mentioned, we think that it's going to fall a little bit, and it was an asset that was unlevered, and we needed access to the cash flow for the redemptions primarily. And then additionally, the residential asset was not performing particularly well and would also have to be refinanced within 2024. So we decided to dispose of that. We're continuing our holdings in industrial, data centers, retail, for the time being, with the option to potentially sell in the future should we need to because of the liquidity situation. Coming to the end, we wanted to show our projected portfolio balance here at the end of 2024, especially compared to our ORECI benchmark. The biggest thing I wanted to draw your attention to was the difference being in data centers. Again, that shows our faith in data centers, and that's why we're holding heavy there.
Great, so I'll bring us to our final section here. We're going to discuss our two investment opportunities and also wrap up with a conclusion for you all. So first up is our equity opportunity, right? So $50 million investment in a kind of Class A building in the Northeast. We've decided to go with the 175 bips financing at an LTV of 50%. A few considerations here, the biggest one being the lease-up rate, where we're projecting that the 10-month per unit or the 10-unit per month rate continues throughout kind of the building as we hold it. And then a few other concerns or kind of risk analysis here is the IRRs, right? They really vary depending upon kind of the rent growth assumptions, right? So scenario 1 and 2 are the ones that we feel most comfortable in, right? Those have our kind of most rational understanding of the rent growth projection. Scenario 2, where we get the biggest upside, that has, as Pat will describe later, kind of our heaviest rent growth assumption there, but we feel that it's unrealistic given the kind of competitive dynamics and the market rent dynamics as well. Just a last few points here, right? Even though this is an equity investment, we're really only seeing kind of subpar, if barely, core plus returns, which raises a red flag for us, as well as this really brings our kind of fund close to, if not at, our 55% LTV threshold. SWOT analysis for the strengths, I think it really comes down to demographics, right? This is in a really affluent neighborhood base, a very strong asset class. We think we'll be able to command kind of market premiums when it comes to rent. We're also acquiring it at a discount to replacement cost. Weaknesses really boil down to the credit market, right? Debt is incredibly expensive right now. Our projections show kind of the first few months of negative operating cash flow given the debt that we've decided to take on. And also the 10-year treasury rate, which is the base of our cap rate, that is really eating at kind of the valuations that we see upon exit at year 3. For opportunities, I guess limited supply in the space long term, right? Limited supply up until 2025 with obviously the new asset class coming available next year. And then kind of for threats, is again, boiling down to the lease-up opportunity. We're projecting that 10 unit per month that rate kind of continues. That's one of the biggest assumptions we made in our model, as well as the competing property, and then thinking about, right, and deploying money means that we have less money to deploy for our investors, meeting the redemption requests, and then kind of thinking about debt and reaching that LTV ratio. And I will pass it off to Pat, who will dive a bit deeper into the model.
So as Sheldon mentioned, each of our scenarios have different rent growth assumptions. Scenario 1 and 3 have relatively normal rent growth assumptions where they're trending rent a little differently. But scenario 2 has this rent to income ratio that we employed, and doing that raises it from the market rents almost 40%, which we viewed as not realistic for the local market. So with that, we're going to rule out scenario 2 as even a possibility. While it does have strong returns, just not likely. So then if you look at scenario 1 and 3, we're seeing single-digit IRRs, which is not attractive to us and does not meet our benchmark. So with that, we're going to recommend do not invest. So just to reiterate, scenarios 1 and 3 are below our return threshold. Scenario 2 is not realistic. And the expected cap rate expansion in the current market environment makes this investment opportunity particularly troublesome.
Great, so we'll move on to our credit opportunity, right? So we will maintain that $42 million piece of the mezzanine and the 168 whole loan. Things that we're thinking about here is that we're working with a reputable borrower that we worked with in the past. We're pretty confident in their ability to meet the debt obligations. And then we've also identified somebody for that senior loan piece, which allows us, again, to focus on the mezzanine position, which gives us that 12% expected return, 10% minimum return, so fitting nicely within our Core Plus mandate. A few considerations here, right? Given it's a debt investment, we don't get that upside that you might see in the equity investments. But that said, it does allow us to remain within, as Bethany and Spencer mentioned earlier, that 55% LTV threshold. For a SWOT analysis, again, as a lender, we'd be able to take advantage of the really compelling credit opportunity, get those Core Plus returns in a very compelling asset class, right? We do believe in kind of residential in the long term, specifically in the Sun Belt. Weaknesses, again, just that limited upside given it's a credit investment, and also we want to be conscious of the opportunity cost, right? There might be other deals that pass our desk in both industrials and data centers, which we have very strong conviction in, and taking on this deal might limit our ability to invest in those. Opportunities, again, that consistent interest income that we could use to think about for redemptions moving forward, and then kind of diversifying our portfolio away from equity investments, which have suffered write-downs given the macroeconomic circumstances out there. And then for threats, right, limited short term. I mean, in the short term, there'll be an increase in supply in this asset class, which might impact our growth, our NOI growth just temporarily. But again, we do believe in the long-term supply-demand fundamentals here. And yeah, I'll pass it off to Pat.
So to summarize what Sheldon just mentioned, we do recommend investing in the credit opportunity. It does meet our benchmark, and it also allows the fund to stay below the LTV threshold. And in conclusion, our objective here was to generate Core Plus returns for our investors, manage our liquidity over the long run, staying below our LTV threshold. And to do that, we're going to recommend disposing of our storage and luxury residential properties, investing in the credit opportunity. But with this strategy, there are several risks. So one is high write-downs, bringing us closer to our LTV threshold, and also the continued interest rate environment. As we continue to look forward into the future, into the coming years to ensure our growth, we just want to continue to update this presentation, monitor macro trends, and stay diligent in the process. So with that, that concludes our presentations, and we'd like to open it up to questions. Thank you.